Hello financial fans, welcome back to another stock analysis. Today we'll be covering Wendy's, stock ticker WEN. Wendy's is an American fast food restaurant chain that was founded in 1969. The company is known for its square burgers and is one of the largest quick service hamburger chains in the world, with a presence in over 30 countries. Wendy's menu includes a variety of items including burgers, chicken sandwiches, salads, and sides, as well as breakfast items, desserts, and frosty shakes. The company operates both company-owned and franchised restaurants with a mix of traditional inline restaurants and end-cap restaurants, and also drive-through locations. Wendy's prides itself on using high-quality ingredients and offering menu items that are made to order, with a focus on providing customers with an exceptional dining experience. In addition to its focus on quality food and customer service, Wendy's is also known for its innovative menu offerings and advertising campaigns. They currently operate over 6,700 locations and they're sitting at a $4.7 billion market cap. In 2021, they generated a revenue of $1.9 billion and their dividend yield is sitting at 3.15%. 21% of their revenue is generated through advertising, 28% through franchise royalties, 12% from franchise rental, and 39% from their sales. To determine the final valuation of the company, we'll be using a margin of safety. Margin of safety will be based on the financial ratios, the financial health, and the growth of the company. We'll be using a standard margin of safety of 25%, which can never go below 0%. The margin of safety can either increase or decrease by the ratios that we're going to look at in just a moment. And the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in a scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction from a margin of safety. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction from a margin of safety. The first two metrics that we're going to look at are the EBIT growth and the margin growth. The EBIT has gone up, going from $176 million in 2013 to $333 million in 2022. The average EBIT growth was 7.9%, meaning no change in the margin of safety. Margin growth has also gone up, going from 7% in 2013 to 22% in 2022, a big increase. In this case, a 15.4% average margin growth yearly, meaning a 5% deduction from a margin of safety. The next two ratios are the dividend growth and the payout ratio. The dividends have gone up, going from 20 cents a share annually in 2014 to $1 a share annually in 2023, announcing a dividend hike of 100% going for 2023. The dividend growth annually was 23.8%, meaning a 10% deduction from a margin of safety. The payout ratio is sitting at 57.8%, meaning no change in the margin of safety. The final two ratios that we're going to look at are the debt to EBITDA and return on invested capital. To get the debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debts. For Wendy, this is very high, sitting at almost 8 years. In this case, a 786% debt to EBITDA ratio, meaning an increase of 5% to a margin of safety. Return on invested capital is 5.9%, meaning no change in the margin of safety. Looking pretty alright so far for Wendy's. So let's go look at the valuation models next to determine the intrinsic value of the company. First valuation model that we'll be using is the discounted cash flow model. I've imported the free cash flow going from 2013 to 2021. The average growth in free cash flow during this period annually was 28%, and I'm projecting an expected growth rate in free cash flow of 7% over the next 10 years annually. With this percentage, we can determine the future free cash flow for Wendy's and determine a terminal year of valuation using a perpetual growth rate of 2.5% and a discount rate of 8.5%. This leaves us with a sum of free cash flow of $7.4 billion, and to get an equity value, we have to add the cash and equivalents and subtract the debt, leaving us with an equity value of $3.8 billion. All that's left to do to get our discounted cash flow price per share is divided by the amount of shares outstanding, leaving us with a price per share of $17.90, which is a 19.75% downside from this point. The second model we'll be using is the dividend discount model. I've imported the dividend payouts going from 4 years ago to the current year. The average growth rate in dividends over this period was 33.4% annually, and I'm projecting an expected growth rate going forward of 5% annually in their dividends. we'll once again be using a discount rate of 8.5% in this valuation, leaving us with a price per share of 30%, or leaving us with a price per share of $30, which is a 34.47% upside from the current stock price out of this model. Third model that we use is Graham's revised valuation formula. In this model, we'll be looking at the earnings per share that Wendy's is generating, the growth rate estimate projected by Wall Street, and the current yield of AAA corporate bonds. And we go by the theory that a PE ratio of a company with no growth is at 7. Looking at all of these metrics, our fair value out of this model is $23.33, which is almost a 31.5% upside from the current price. And the fourth model that we'll be using is the multiple valuation. In this model, we'll be looking at similar companies to Wendy's, look at their stock price and the earnings per share. This way we can determine the average PE multiple in the industry, which in this case is 22.69. All this have to do to get our fair value is to multiply by the earnings per share that Wendy is generating, which is $1.66 a share, leaving us with a fair value of $37.67, which is almost a 69% upside from the current price out of this model. And the last model that we'll be using for our valuation is the mean reversion theory. In this model, we go by the theory that a company will always trade above or below its mean, and the metrics that we use to determine this are the dividend yields and the PE ratio. In this case, I've imported the dividend yields from the past 5 years, and on average, the yield during this period was 1.96%. The current yield is 2.81%, meaning that it's undervalued as the yield is currently higher. The second metric was the PE ratio, and the average PE ratio from the last 5 years was 22.54. The current PE ratio is 13.49, indicating again that it's undervalued currently, because the PE ratio is lower than the average from the last 5 years. This leaves us with a fair value of $34.62, which is a 55.17% upside out of this model. Let's go look at the final overview of our valuation models next. Looking at our final overview, we've imported the discounted cash flow, the discounted dividend, Graham's valuation, the multiple valuation, and the mean reversion theory prices per share, leaving us with an average of $29.91. We've determined the margin of safety earlier, using a standard margin of safety of 25%, adding 5% for the debt to EBITDA, deducting it by 5% for the margin growth, and another 10% for the dividend growth, leaving us with a 15% margin of safety. Applying this margin of safety, we get a fair value of $25.42, and with the current price of $22.31, this is almost a 40% upside, so in this case, it would indicate a buy from our models. If there's any other dividend stocks that you would like to see me cover in this channel, please let me know, and thanks for watching.